This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
The FOMC began its two-day Fed meeting. Of course, we get the decision tomorrow. So let's see what Dr. Stephen Skancke has to say. He is back with us, Chief Economic Advisor at Keel. He's a former U.S. Treasury and White House National Security Council member. He's on Zoom in Washington, D.C. And Steve Matthews writing about the Fed and the clash of Fed hawks and doves deepening. Steve, of course, is Bloomberg News economics reporter. Steve Matthews in our D.C. bureau. And let's just set the backdrop. Dr. Skancke, let me start with you. What are you anticipating, or what's important about the Fed meeting tomorrow? Because we pretty much expect we're going to get another quarter-point rate hike. Unanimous or not?
Yeah, I think that's right, Carol. And it is great to have you back, Tim. And congratulations on your family.
He's helping out the economy.
That's wonderful. That's exactly what we need, and build up that labor force potential down the way.
All at the service of the economy. Thank you. Also, truly though, Carol, you make a funny point. Supporting a local economy. I mean, I really saw the balance of spending shift from being in Midtown, right, to being in low local neighborhood, where it's like, Tuesday through Friday is like a weekend during the week.
I bet, right? Because of all the stuff you guys were doing.
Exactly.
All right, so Dr. Skancke, Steve Skancke, what do you expect the Fed? What's important about tomorrow's decision?
Well, I think the 25 basis point increase, which takes it to a 22-year high on the Fed funds rate, is baked in. And I think it's also probably highly likely that they're going to continue to indicate a bias toward further increases. This is the hawkish view coming out, absent significant improvement on inflation. And the thing is, they can do that. I mean, they truly are emboldened. The hawks in particular are emboldened by the fact that we still got a robust labor market. We still have about a 2-to-1 ratio of vacancies to unemployed. There's a positive earnings outlook over the next 12 months. The earnings decline typically in this sort of environment would be earnings growth would be down 18%. It's down about 6%. Strong consumer balance sheet. You probably saw that the consumer net worth has bounced back up to 152 trillion, which is what it was at its high. And the S&P is up 18% year to date. What has the Fed got to lose by not getting head faked again on declining inflation?
Okay.
So sure, they're going to be hawkish. There's no percentage for them to look like they're softening.
Well, let's talk about that divide. And for that, we turn to Bloomberg News economics reporter Steve Matthews, from Steven to Steve. He's in our D.C. bureau. Steve, you wrote about the cracks inside the Fed deepening. Right now, what are the doves saying?
So I think the big picture here is everyone was hawkish over really the last year, and really last year and 3 months, because we had high inflation, we had low unemployment, and so there was great unity around the FOMC table. And now, as we're reaching the end of the hiking cycle, which a lot of Wall Street believes that tomorrow's hike is going to be the very last one, you're starting to see a split. On the side of the hawks, people like Chris Waller, the governor, and Jim Bullard, who's retiring, Loretta Mester of Cleveland, they are saying, we want to avoid the 1970s inflation again, and we're going to do whatever's necessary, and we'd rather err on the side of doing too much, and we have too hot of a labor market, and until that starts to show some cracks, we're going to have too much inflation. On the side of the doves, people like Raphael Bostic and Austin Goolsbee, Bostic from the Atlanta Fed, Goolsbee from the Chicago Fed, are saying, basically, let's not overdo it. And, what the problem with the inflation over the last 2 years is not that we've had too much demand, it's that, we've had a pandemic, and the pandemic has changed the economy, and you've had all supply disruptions and all these, disruptive changes, and that's what inflation is about. So we don't really necessarily have to overdo it.
Feels like Goldilocks and the three feds, to be quite honest with you. I mean, what's great is, too, I don't know if you guys read the editorial by Bloomberg editors. It's a Bloomberg opinion piece, but they remind us that if you look at the so-called core CPO, still 4.8% higher in June than a year ago, right? And so if, Steve Skancke, if the Fed is truly committed to 2%, and this opinion piece says the Fed shouldn't settle for above target inflation. If 2% is the real target, then we have to be careful, or the Fed has to be careful about pulling off the brakes, too early. And then inflation rearing its ugly head again. Housing starting to come back again. Wage pressures, wage inflation, still an issue.
Well, that's right. But when we look at the June CPI number, core prices were up only 0.16 month over month, which is equivalent to slightly less than 2% on an annualized basis. And I'd be the first to caution against trying to extrapolate too much from a 1 month move, but it's an indication that they can actually achieve their goal. As I said, there's no gain for them to back off from it at this point. And given how well other things are doing, I think they will err on the side of certainly hawkish rhetoric. Now, I also happen to think that the 25 bips announced tomorrow will be their last. But I don't think that they're going to say that it's their last. They want to keep the attention focused on their mandate and their plan to bring it down. And so I think that's why, notwithstanding, and I don't disagree with Steve Matthews' observations about the split. We even saw a little bit of that with the San Francisco Fed president in pointing out how much the Fed had done already when you add the quantitative tightening on top of the interest rate increases. But they don't want to look like they're giving up on it yet, even though I don't think we're going to see any more interest rate increases.
So, Steve, Matt. Go ahead. No, go ahead. Just quickly. Yeah, go ahead.
The other thing that's out there is over the last 12 months, we've had M2 money supply down 4%. We haven't seen that since the 1930s. Now, and we know that has, on average, an 18% lag. There's in the economics profession, there's a lot of folks that say, "Oh, money supply doesn't matter anymore." But I don't think it's a coincidence that after we raised the money supply 34% in the immediate post-pandemic period, that we got inflation at 9%. 15 months ago.
Yeah.
And when you look at when this basically started, about March or April of next year is when we could expect that to start to bite.
Right. Hey, wait, hang on a sec. Steve, just 25 seconds I saved for you. Unemployment, doesn't it have to go up, though, for inflation to come down very quickly?
There's a debate about that. Certainly the center of the committee, including Chair Powell, believes it does have to go up, that we've overshot full employment and we need to get at least back to maybe 4% unemployment rate. But, there are certainly people on the committee who say, the Phillips curve relationship between unemployment and inflation is dead. So
all right.
We'll have to see.
All right. Well, great story. Steve Matthews, economics reporter at Bloomberg News. Dr. Steve Skancke, chief economic advisor at Keel. And you are listening and watching Bloomberg Radio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
All right. We want to go back, though, to Microsoft. We just talked about their earnings. coming out, as Romain reminded me, the guidance on the earnings call. That's pretty typical for the company. The stock now call it pretty much flat in the aftermarket, but we've seen it bouncing around in a big way. With us right now to talk about it is CFRA Research Senior Equity Analyst Angelo Zino on Zoom in New York City, and then Bloomberg Intelligence Senior Tech Analyst Anurag Rana in our Bloomberg Interactive Brokers studio. Anurag, I want to go straight to you first. I was listening, kind of glued to surveillance this morning. What do you make of Microsoft?
I think everything is slightly above what people were expecting, but the big question is what is going to be the cloud guidance for next quarter, and does it mark the bottom in the declining growth of cloud, or are we going to look at another quarter or so of declining growth and then we see a U-turn because of all the AI workloads that are going to come up?
Remind us what's going on with cloud in terms of, is it business spending just pulling back or what?
Yeah, it is. That is what it is. Law of large numbers added with very pessimistic corporate IT spending. Last year, Azure grew 46%. This year, now it seems, it is around the 27% mark. The question is, the next quarter, is it going to be 28 or is it going to be 25 and below? So that's where we are at this point.
Just give us an idea, Anurag, of what happens with Microsoft and AI and what that looks like from a user perspective. I mean, we've all been there and I think played with ChatGPT. We see the way when we're typing an email on Gmail, it does autocomplete. But when you power services and software for so many Fortune 500 companies, how do you integrate AI seamlessly into those products?
So first and foremost, when you look at anything generative AI, Microsoft is the number one choice for a lot of the software vendors. I mean, when you look at when you want to play AI in generative AI, when you want the chip, you're going to go to NVIDIA. But when you come to software, Microsoft has a lead in terms of intellectual capacity, what they have shown, compared to everybody else. Now they have to show that they can add revenue to it, they can add more cloud usage to it, etc. In the long run, what you mentioned, companies are going to use this technology to power their internal productivity. But again, that could take a while. So we really are looking today to see whether we are seeing an increase in workloads on their cloud portfolio, or are we looking at corporate spending going down and offsetting any of those positives.
All right, Angelo Zino, come on in on the conversation in terms of what we saw from Microsoft.
Yeah, no, I think as far as Microsoft is concerned, it was pretty much in line with expectations. I mean, of course, what we're all kind of interested about is kind of how AI is progressing right here with the company. I mean, clearly, when you kind of think of the Super 7 that are out there in terms of the biggest bellwethers, we think the best ways to play the AI story right now continue to be NVIDIA as well as Microsoft, because those are the ones that have been able to kind of really show the ability to monetize more kind of near term in nature. So clearly it's all going to be about the story that Microsoft tells on the earnings call here today. But that being said, I mean, our view here as far as Microsoft is concerned is they've got so many drivers as far as the AI story is concerned. Their tentacles are in so many different things that if you see any type of significant pullback here after hours, you definitely want to be a buyer of the shares.
Angelo, who should we be concerned about in terms of losing, not market share, but not being on the AI bandwagon? I mean, I hear of Microsoft Azure. I wonder, okay, well, who's the biggest cloud player? We know Amazon Web Services is. Do they have what it takes to compete when it comes to AI?
Yeah, listen, and I don't personally cover Amazon, but I will tell you this. I mean, we do think that Microsoft as well as Alphabet has a distinct advantage given kind of, their exposure within the enterprise space and some of the tools that they're kind of rolling out on the AI side, I think, relative to maybe, what AWS has to offer out there. And just given the size of AWS relative to the others, specifically on Alphabet side, I think we do think the other two in terms of Alphabet and Microsoft are likely going to be share takers here over the next 12 months, at least on the cloud side of things.
Anurag, you mentioned about, the cloud growth that we're seeing, and they're talking about a 26% number. The number that we got a year ago, was that just off the charts? So that's not a fair comparison, or no?
No, they have been growing much faster than the year before. So, and that's also a function of Microsoft's cloud portfolio is much smaller than Amazon's. So it's just a matter of them catching up, moving a lot more of the on-premise workloads onto their portfolio. So the growth story for Microsoft Cloud's been there. last year we saw an unusual slowdown over the last 12 months. The question is, how long is the slowdown going to last? In our view, it's going to be either this quarter or next, and then we should start see a U-turn.
What I don't get is, everything's in the cloud. I throw more stuff in the cloud. Everybody throws more stuff in the cloud. So so when we see a little bit, so help me.
So the consumer side, I get it. All my pictures are in cloud.
Right.
But when you look at corporate
It's like another expansion.
When you look at corporate IT spending, less than 20% of the workloads, less than 30% of the workloads, depending on how you define it, the majority of corporate IT spending is on premise. So we have a decade of growth over here.
But does it stay on premise for security reasons? Does it stay on premise?
No.
But
it's just lethargy. It's just legacy IT. You've spent $20-30 billion of, I'm just saying, let's say a big bank over the years just to develop a lot of these applications in-house. It's just going to take time for that to move.
Hey, Angelo, what's the number one question? Or come on in on the conversation.
Yeah, no, as far as kind of what we're looking for, at least for Microsoft here, it's really kind of, to the extent, to what extent are they going to be able to monetize, the AI revenue here in the September quarter as well as the December quarter, if you're kind of, more near-term oriented in nature. And, our view again is, when you kind of look at some of the commentary they provided in terms of Copilot last week, in terms of it, coming in at a price point about $30 per seat. As well as kind of, again, those cloud opportunities kind of, even potential, the search expansion potential that they've got on that side of things as well. We do expect revenue to accelerate here in the September quarter and therefore, and also in the December quarter. If you don't see that, I think really, that's where the stock could really take a hit. So that's what we're really kind of looking for as far as, what to expect and how to kind of look at the stock here going, through this earnings.
Yeah, at the close, the stock was up 46% so far this year. Right now, we're seeing shares of Microsoft just trending a little bit lower in the aftermarket, down about 1.5%. All right, guys, thank you so much. So appreciate it. Angelo Zino, Senior Equity Analyst over at CFRA Research, joining us in New York City. Anurag Rana, right here in our studio. He is Senior Technology Analyst at Bloomberg Intelligence.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So we're going to shift a little bit from earnings. Tim, we've been talking a lot about the current cover of Bloomberg Businessweek. It's all about WW Weight Watchers and their new strategy where they are really banking big time on this kind of new class of weight loss drugs. So we're talking about Ozempic and Wegovy. Wegovy, am I saying it right? Wegovy.
I was going to ask you.
Yeah. And so we wanted to take a little bit of a bigger look at what's going on with obesity, because we have definitely seen the worldwide economic impact of obesity and excess body weight expected to more than double to $4.27 trillion in 2035 from 2020 levels. There is a big cost, healthcare-wise, productivity-wise, and just health-wise for individuals.
Fortunately, this afternoon we've got Dr. Angela Fitch with us, the co-founder and chief medical officer at the Boston-based healthcare practice Knownwell, president of the Obesity Medicine Association, OMA. It's a network and networking group for healthcare providers. Dr. Fitch is an assistant professor of medicine at Harvard. She joined us via Zoom from Boston. It's good to have you with us, Doctor. Thank you so much for joining us. So talk a little bit about, Carol laid this out for us, but obesity, not just a problem for health and a problem for healthcare. Lay out the problem, why it's just such a problem for society and not just America right now.
Yes, I think Carol did an amazing job of highlighting that. Not only that, so many people are focusing on the cost of medication right now, but there's a huge cost to not treating obesity as well. The WHO a few months ago the World Health Organization published a announcement saying that we are spending as much on obesity as we did on COVID every year. So in other words, the COVID pandemic, the cost of the COVID pandemic across the world is what is also spent on the disease of obesity. So it's not trivial. And now that we finally have effective treatment for it, we really need to find a way to work together at all levels to try to help people get access to this care.
What do you think of these weight loss drugs, Ozempic? I know individuals who are taking them, some are diabetics, and it's a game changer in terms of their levels really kind of evening out, and they're losing weight. And then we know the celebrity stories and all these people who are taking it to just lose a lot of weight. But what do you think of this class of drugs?
So in our obesity treatment space, the 5,000 clinicians that are members of our Obesity Medicine Association that I'm the president of right now and honored to be so, all of us are very excited about today and the future of weight management. And we like to talk about these drugs as anti-obesity pharmacotherapy too, right? Because they're not just about weight loss. We're talking about treating a disease of obesity, which isn't just focused on a number on the scale. There's many reasons why people want to lose weight: to be able to be more mobile, to be able to do better at their jobs. For some people, their livelihood depends on it. So again, it's a very important thing to consider them as anti-obesity pharmacotherapy. And that is really the Wegovy, right? Because Wegovy is approved for weight management, while Ozempic is approved for diabetes treatment. And so again, we do want to focus on the right language, as we talk about these treatment strategies.
Well, this is just one strategy when it comes to treatment strategies. What are other treatment, but it's one that's getting a lot of attention right now for a lot of reasons. What are the other strategies that people should be focused on?
Well, again, this is all part of a comprehensive care pathway, right? For any chronic disease, whether that's diabetes, hypertension, heart disease. We've always focused in medicine on not just the one pillar of treatment, which is a medication option, but on other lifestyle factors as well. And for other chronic diseases, we've always focused on this. But we've never made people necessarily jump through the same hoops that we make them jump through when we talk about obesity, because there still is a large societal feeling that obesity should be able to be treated by oneself, that we can somehow overcome this disease by our own willpower or our own accord.
I have a colleague who said, it's exactly what this individual says to me. It's like, it's just a choice, just don't pick up the ice cream.
And that's
kind
not
of thing.
The case, right? We find scientifically, actually, that that's not the case at all. That this is a multifactorial disease. And certainly lifestyle changes are very important for all of us. The environment we live in is not healthful today, and we need to work to change that also, right? At the higher levels, right?
How high the government? Yeah. So talk about what you think the government should do.
Well, that's always hard to say exactly, because it goes back and forth, depending. But I do believe that we have to make changes, even, at the society level, where we can make choices, right? So we can choose to vote people into office that are going to support more broader treatments for obesity as we look towards the future too, and also making our lives more healthful as well. Providing more access to fruits and vegetables, providing more access to whole foods instead of processed foods.
Dr. Fitch, though, you know what? I feel like I've heard that, just like a couple of other things about diversity and so on and so forth. I've been doing this a long time. Tim has too. It's like the idea about a healthier diet. I get it, and then you have a massive processed food industry, sugar,
food deserts in many cities.
So
it's hard to manage.
How do we fix it?
Well, I think we fix it. I think that's the multi-trillion-dollar question. I'm not sure how we fix it as a society. We have to move towards some of the things that higher level, people have talked about in this this is not sort of my level of expertise as well as far as food policy goes. But I do think that the more we as consumers as well, at the grocery stores can make those choices as much as we can. And again, we recognize it's hard for a lot of people, but we're also improving that at local environments. At the Mass General Weight Center, where I used to work, and at Mass General in general, we have a food bank now that provides fruits and vegetables to people who live in food deserts. So there's a lot of these sort of groundswell of things that are cropping up across communities, I think, to help in the community setting, to improve access to nutrition.
Now, all part of this important conversation. As we said, the cover story of Bloomberg Businessweek is all about what WW is doing with these drugs and their new strategy. Dr. Angela Fitch, thank you so much. Really enjoyed it. Co-founder and chief medical officer at Knownwell, and as we said, and president of the Obesity Medicine Association.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
You drive me crazy.
This is The Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, TikTok, everybody. Under 18 minutes left in today's trading session. It's a big day. We know the Fed kicked off its two-day meeting, but what we're really focusing on, Tim, is the Microsoft and Alphabet earnings after the close bell.
Are
We've got
we,
Snap
or
and
are we
Tex-
focusing on the Fed decision?
No, it's earnings right now.
But
Don't
you know,
feel
remember. I mean, think back to 6 months ago.
I know.
What was driving the market? Was it what the Fed was doing, or was it the earnings of one or two
I
companies?
feel like it was, the big macro for
Exactly.
Right? But
Sounds like you read a nice little article earlier in the day.
I want to know about fundamentals.
Okay.
I want to know. I also want to know what Michael Sheldon has to say. He's Executive Director and Chief Investment Officer at the Registered Investment Advisor Hightower RDM Financial Group, joining us once again on Zoom in Westport, Connecticut. It is a big day. Michael, good to have you here with Tim and myself. Big tech earnings, the Fed decision. What's more important to you, and what do your clients most ask you about?
Well, there's a lot going on this week. We have 166 companies in the S&P 500 reporting, none more important than some of these big tech stocks. I think for this full week, the three things we're watching the most are, one is all the earnings that are coming out, two is the Fed meeting tomorrow, and on Friday is the PCE inflation index, which the Fed has been watching pretty closely. So I think overall, investors are wondering what the outlook for the market is in the second half of the year. We came into this year with a lot of pessimism. I mean, there were some reasons to be negative. There were a lot of the traditional historical sort of economic indicators, like the shape of the yield curve and the leading economic index, which historically have forecast recession. So there was a lot of pessimism in the markets. Fast forward to today, things are sort of in a better place. I think investors are looking at the market with a sort of a glass half empty, as a glass half full, as opposed to glass half empty right now. So we don't think we're completely out of the woods, but things are a little bit better than they were starting the year.
I mean, if you look at the S&P 500, things are a lot better than the start of the year. We're up close to 20%. The big question is, what could derail this rally?
Yeah, so that's a good question. I think the thing that has stood out to us for a while is, one is that the Fed overdoes things. Historically, unfortunately, the Fed has a tendency to crash the party. So if they raise rates more than expected, tomorrow there's like a 99% chance of a quarter point rate hike. And then following that, there are three more meetings this year. So interestingly, at each of the next three meetings, there's about a 20 to 35% chance that the Fed raises rates by another quarter point. So if they raise rates too much, that would be a factor. Second would be if inflation does not continue to come down as expected, that would be a problem, because that was sort of factored into a lot of investor sort of outlooks that the Fed would be able to move the sidelines. And third, most importantly, is since stocks tend to follow the direction of corporate profits over time, if corporate profits don't follow through and rise starting in the fourth quarter of this year and early next year, that could be a problem.
I want to jump in for a second, because you said the Fed could crash the party. Sometimes you have to crash a party. Sometimes you have to do the unthinkable. Just ask, Paul Volcker what he had to do, right? There is a lot of writing going on that if the Fed is true to that 2% rate, as you said, that one of the things that you are watching of three is the PCE inflation index. Mm-hmm. So if the core or whatever metric that the Fed really watches that is still above 2%, if that's what we've got to focus on, then maybe the Fed has to keep raising rates. Do you agree with that?
Yeah, the Fed's walking a tough line here. In some of the speeches that Powell has given, he's been firm about bringing inflation down to 2%. But it is possible that if inflation gets down, say, below 3%, and we start to see weaker economic data.
Which inflation, though? Which inflation? Because there's so many different ways to dice and slice it.
A good point. So the real inflation rate that he's watching is the core PCE index. You could also throw in the core CPI index, but the core PCE index, which is much higher than 2% right now, is sort of what he's looking for. Mm-hmm. So, just to put things in perspective, the overall CPI inflation rate was 9.1% a year ago this month, and now it's down to 3%. The core PC index is currently, I believe, at 4.8%, and that was either in the mid fives or mid sixes about a year ago. So inflation is coming down. The core numbers not as quickly as expected, although based on a number of trends, it does look like those numbers should continue to sort of move lower as we go through the end of the year.
Is this rally warranted, Michael?
I think we're starting to see a little bit of exuberance in the market, or maybe you could look at some of the sentiment indicators, which are starting to get a little bit, maybe the sentiment indicators are starting to heat up a little bit, just a bit. For example, if you look at the American Association of Individual Investors survey, we almost have 30% more bulls than bears, which is the highest we've seen in some time. In addition, if you look at valuation levels for the forward 12 months for the earnings for the S&P 500, we started the year at a little over 17 times, and now we're over 21 times. So we've seen a lot of positive momentum in the market. Some of it's warranted because it looks like a recession, the possibility of a recession or a downturn in the economy has been put off till later this year or early next year. I think the rate of increase in the markets will probably start to ebb a little bit. But one last thing I think is important is that we're starting to see some broadening in different parts of the market. So for example, so far this quarter, the equal weighted S&P 500 is outperforming the S&P 500. And areas of the market like financials and energies are outperforming tech. So that's a healthy thing for the market to continue to move higher.
Would you be buying big tech like your Microsoft or your Meta or your Amazon or your Netflix at this point?
We're big believers in technology. You need to have some growth in your portfolios. We're financial advisors, so we're trying to make sure that clients meet their long-term investment objectives, whatever those may be. So you want to have some technology in your portfolios. We own the big cap tech stocks, not all of them, but we own them. I think the important thing is to size them appropriately within client portfolios.
So just about 30 seconds left, Michael. What would you say to somebody who sat on the sidelines with a lot of cash over the last few months and missed out on this one?
Sorry.
Well, I think the important thing is this, to understand that client's long-term investment objectives. Obviously, you have to think about their risk tolerance levels, but it seems like the markets are likely to continue to sort of grind higher into the end of the year. There are a lot of investors sitting on the sidelines. We have more than $5 trillion in money markets. Not all of that's going to come out because cash now has an attractive yield. But as long as the outlook for the economy is such that it's so resilient and the outlook for a recession is put off till next year, I think the odds of further upside in the markets is positive, although we certainly will have some sort of pullback or correction before too long.
It does feel like we need a little bit of a correction. I feel like a lot of people are calling it. There feels like so much enthusiasm out there. Michael Sheldon, Executive Director and Chief Investment Officer of Hightower RDM Financial Group, on Zoom from Westport, Connecticut. You're listening and watching Bloomberg Businessweek on Bloomberg Radio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.